Hi guys, my name is Nicolette Mashile. I'm also known as the Financial Bunny. Welcome to the Financial Bunny TV. We're talking all things in investing for a beginner. Now remember that none of my videos constitute as financial advice. If you are looking for financial advice, please speak to somebody who is certified and registered with the FSCA. So in this series of videos, what I'm going to do is to look at different investment options, especially for the novice investor. It's quite important to start moving into the direction of investing. Yes, we've been pushing people to save, and saving is a prerequisite of investing. Not necessarily that you must save so that you can invest, but if you understand saving, it'll be easier for you to be able to understand the importance of investing, right? No, Robert Kiyosaki has some phrase where he says saving is for losers, whatever. It's not always going to be true. Yes, most of us do need to invest, and I'll give you the reason why by contrasting the two things and what are the definitions of them. When you are saving, a lot of us either save one to try and preserve the value of our money. So I don't need the money right now, but I want to be able to keep it and I don't want it to lose its value. So you save in a structure that is going to beat inflation by the rate at which the value of your money grows, whether it is tied up into something or whether you are keeping it in an interest-bearing account. So let me explain that. If you are running the 100 meters, this is your money, this is inflation. You have to cross the line at the same time that inflation crosses the line so that your 100 rand that you're putting away today can still buy you the same things in 12 months' time. That's when you're preserving the value of your money, right? When you are saving for future use is when we say you've now saved the money, you've preserved its value, and you now have a need to use that money at a later stage, and you want that money to still be able to buy the same things. The third reason why you would save is for emergencies, so that you don't have what is called an economic income interruption, where you now have to go look for reserves or where you have to use credit because you don't have additional amounts of money to pay for the sudden thing that has happened in your life. So we save for emergencies. So what is investing? Investing, on the other hand, still again, you are fighting to keep up with inflation, but in this case, you don't only want that money to be able to buy you the same thing that it was buying you a year ago, you want it to buy the same thing plus more. So essentially, you want the money to grow, right? It could be growing through returns, interest returns, or it could be going through a capital gain, right? So it's very important for you to understand that. And the reason why I start off like this is because I want us to get out of this mindset where we think that investing can only be done in these formal spheres that we've created. We always give ourselves these hernias and we give ourselves ulcers because we think, oh my goodness, the only time I'm going to be investing is when I've got a stock portfolio. That's when I'm going to feel like an investor. If I've bought rental property, that's when I'm going to feel like an investor. No. Investing is when you take your hard-earned money or money that you've borrowed from the bank, and that's called leveraging, right? It's when you take money and you put it somewhere, either into an account or into a physical asset, or in a physical, or not necessarily a physical asset, but a service that you know for a fact that over time, whatever it is that you are putting your money into, it is going to be worth more than what you have paid initially. So it doesn't matter because the thing is, we all get so bogged down by trying to fit into these 5 asset classes that we've created for ourselves, which is the real estate market, the bond market, the stock market, commodities, and what's the last one? Cash. Those are just high level asset classifications. But if you actually looked at some of the things that we buy, even Komaraing, you start to realize that they actually fit into one of these asset classes. It's just that sometimes we want it to be formal. We want it to come from Anna Marie somewhere there who's going to send you a formal email with the company name there, Yes, it's good for regulation. Yes, it's good for safety of your money. However, if you start thinking about investing in a manner that you understand that it is you taking your money, putting it into either a cash, a bond, a property or real estate, stock market, commodities are things that we buy and sell. And whatever you're putting your money in, when you decide to take it out, it's going to be more than what you're putting in. Or the difference of when you buy versus when you sell, that is where you are actually going to say, yes, I have actually been an investor for this long, and here is my return, or here's my capital gain from this specific thing. So that's important, right? Now, I'm going to start off this series with talking about the stock market. And the reason why I want to start with the stock market is I want us to get into the space of understanding that fintech companies have really tried to make investing accessible. They've made real progress in this country. That is fintech companies like Frank, fintech companies like Easy Equities. In actual fact, even the more traditional companies are now starting to realize that actually we need to make investing a little bit more accessible to the ordinary man on the street. So you will see the guys of Alan Gray, the likes of Prudential, the likes of Sanlam. They're starting to make various funds easily available to people. One of the things that Easy Equities, for instance, has done is that they've introduced what is called fractional investing, where if you don't have the full amount of money to buy a specific share, for instance, which is the thing that we are all doing now, right? We're all investing into the stock market and we're all trying to buy individual shares, right? So what they've done is they've said, and I don't know what the current share price of Capitec, for instance, so let's use it as an example. And for the sake of this video, which is quite hypothetical, let's say it's 900 Rand for a share of Capitec. If you can't pay a full or invest every month a full 900 to buy one full share of Capitec, you can buy it as a fraction. So you will buy one, let's say for instance, you have 300 Rand. You have 1/3, then you'll buy this 2/3, and then you'll buy 3/3. Do you get it? I was not good at mathematics. So even with fractions, they tend to deduct me. But essentially what I'm saying is if you pay 300 Rand as an investment amount of money over 3 months and the share price stays 900 over those 3 months, you could potentially after 3 months have one Capitec share. The problem with that is that you are now putting all of the risk of Capitec on your shoulders. So let's say after 3 months you celebrate, yes, I've got the share, I've got a Capitec share, and then something happens at Capitec and Capitec's share price is, let's say, half of its value is wiped away and the share drops to 450. When you actually sell your position, you would have made a loss of 450. Only when you sell. Very important again. You don't lose your value if you do not sell, right? So it's important to understand that there is a huge risk in buying individual shares. But of course, remember, high risk, potential high return. So that's one thing that we just need to remind ourselves of. There is, however, a lot of options where you can diversify in terms of what you put your money into, where you put your money into, and you minimize the risk of taking a big knock if something happens to one specific company. And today's alternative to buying individual stocks, or even sometimes to buying, for instance, an individual asset, is putting it together in a unit trust. So what is a unit trust? Basically, it is a fund that is created and it needs to be registered, right? So all unit trusts are registered in the jurisdiction of where they are. So in South Africa, we have a unit trust registration. So if a company is going to hire a fund manager to put together a unit trust, they need to register that unit trust. So how is a unit trust put together? In other words, what asset classes does a unit trust invest in? Well, this is determined by the mandate, right, of its investors and also by the risk. So the different asset classes come with, I would say, a risk allocation. So property, for instance, because it's in real estate, will get maybe a C risk grading, right? Stock market, because it's volatile, will get a D risk rating. Cash, which is less riskier than all of the asset classes, will maybe get an A+ rating. So depending on the mandate that the investors or the fund manager has taken upon on this specific unit trust, there is going to be a risk. So you will see that in a 100% breakdown, maybe 80% will be in cash, maybe 20%, 10% will be in stock market, even not just stock market, tech stock, and then another 5% will be in real estate, and the last 5% will be in the bond market, right? So that is the makeup of the actual unit trust. Now, that unit trust is then taken up and it is split into equal units, right? And then what they do is they pool monies from many investors. So kind of like a stokvel. Or let me put it this way. Let's say you and your siblings are going to a family function and you all are responsible for the meat, right? So you guys decide to buy a cow, you decide to buy a sheep, you decide to buy maybe a goat, right? So you've got those three, and maybe a couple of chickens, right? Just for spice, right? So you've got all of those different types of meats. But not all of the slaughtered animals end up being eaten on that day or actually cooked on that day. And your mom says, or your mom and dad say, actually, we don't have a freezer, so we can't keep all of this meat, right? So then that meat together gets put into different equal units. So maybe there's a couple of chickens here with a little bit of a leg of of the sheep, a leg of the cow, a leg of the goat, and it's equal units. However, the distribution to the different siblings will be based on the contribution that the siblings have made. So if you are that sibling that only contributed 300, you get 300 rands worth of units, right? So that's how the units work. Now, unlike the other structure that I'm going to speak about in another video, which is the ETF, the unit trust is passively managed. When I say passively managed, it is the pricing of the unit trust itself, or the value rather of the unit trust, is that the net value at the end of the day when the markets have done what the markets need to do. So unlike the ETF, which you could literally buy now and I buy 3 hours later and we could buy that ETF at different prices, right? You would be buying units. So there's a specific price for the unit. However, you could give them 300 rand and say, I want to buy a couple of units with this 300 rand. And based on how much a unit is, it will determine how many units you actually get, right? So, but this is not fluctuating throughout the day. So you will get the price maybe in the morning of the unit trust, and at the end of the day, you'll get a different price based on the different asset. So based on the cow market's movement, the chicken market's movement, the goat's market movement, all of those things will determine what the price of the individual unit is. And with your contribution, it will determine how many of those units you are actually able to buy. Now, this is important because when we talk about rand cost investing, which is another strategy in investing, especially for beginner investors. What do we mean when we talk about rand cost investing? Basically, it's a copy from the dollar cost investing, right? So essentially we say you have a certain amount of money on your budget line that is allocated to investing. You could use that budget line to invest in unit trusts, right? So let's say you've got 1,000 rand every single month to invest in unit trusts. What we're saying is, come hell or sunshine or rain or storm or beautiful cloudy days, with a rainbow, your 1,000 rand is going to buy you a certain amount of units, right? Depending on the value of the actual unit trust, The different units will be priced at a different amount almost every single month or every single day. So when the market is down, a lot of people panic and they want to leave investing. We're saying it may just be valuable for you to stay in. Why? Let's say your unit trust, the different units within your unit trust are priced at 50 Rand in a good market where all of the assets that your unit trust invests in are performing really well, right? 50 Rand per unit. So with your 1,000 Rand at 50 Rand, you are able to buy how many units? So we take 1,000 divided by 50, which means that you are able to buy 20 units every single month, right? But if the market is down and some of the asset classes markets that you have invested your unit trust in are doing badly, and the units within the unit trust drop and they all individually now priced at 10 Rand, how many units are you actually able to buy? So again, we take that 1,000 Rand that you are regularly putting in every month without changing the amount. You now are buying your units at 10 Rand a unit with 1,000 Rand. So with 10 Rand, you are able to buy 100 units, right? Every single month. Then the next month, the units go back to being 100 Rand for each unit. Now, the value of your portfolio has grown because you still held on to those units. You went to buy at a sale. There was a sale last month where the units were now 10 Rand. With your 1,000 Rand, you bought 100. Now, the price, the market corrects, and the units go back to being, let's even say, correct and performs well. The units go to being 100 Rand for a unit. So with your 1,000 Rand in that month, you're going to buy 10 units. However, last month, you bought units, 100 units. But now in this new month, they're not valued at 10 Rand a unit anymore. They're valued at 100 Rand for a unit. Do you understand where I'm trying to get at? It's very important for you to take time and actually understand what I'm saying. So it's like going into a sale, right? On a normal day, cows may be 4,000 Rand. On a sale, cows are 1,000 Rand. So with your 4,000, you're now able to buy 4 cows. But the day the market corrects and cows go back to being 4,000, you have 4 cows that you bought 1,000 Rand, but they're now priced at 4,000. So it's 4 times 4. You have 16,000 Rands worth of cow. So it's important to understand these things, that you don't cut your nose to spite your face when you think, oh, the market is down. But when the market is down, that's when you must buy more units. So it's important to think about it that way, and it's a nice way to get into investing through unit trust. I have heard people complain that unit trusts take long to actually make you money. Remember, it is one of your investment strategies, or one of the ways in which you invest. It's not the only way. So you are going to have a nice asset allocation and a nice financial instrument allocation. So even in your asset allocation, you may say, I want to invest 30% of my money into real estate, 30% of my money into stock market, 30% of my money into cash, and maybe another 10% of my money into the bond market. But even within that asset allocation, you would need to choose the different financial structures or instruments. So you will be now exposed to the likes of mutual funds, the likes of unit trust, the likes of ETFs, the likes of bonds, the likes of REITs, which is a real estate investment trust, TFSAs. There are many financial instruments that you can use. 1, to achieve your asset allocation, 2, to diversify, 3, to manage risk, but 4, also in terms of affordability and making sure that you are growing this wealth portfolio of yours that you are now trying to achieve through investing. I'm hoping that with this series, we can start moving ourselves towards a healthier financial investment portfolio for all of us.